July 4th surge is around the corner. Where will all the trucks come from to haul it? That's the big question of the week. Welcome to the DAT Freight Market Update. I'm your host, Dean Croke. And yes, truckload capacity continues to tighten despite lower volumes last week. First week of the shipping month, January is a little bit quieter, but rates continue to rise. Capacity still hasn't returned to pre-road check week levels. That's very interesting in and of itself. Big question I've got is, where will capacity come from? Talking to some of our clients last week who are already out booking freight for July 4, there's a general tightness in capacity that we haven't seen this far out from peak. It's an extraordinary moment in our transport history where supply is exiting much faster, I think, than we all thought, certainly much faster than I thought. The next month is going to be a stress test to see how the industry performs when demand really does take off. I've been driving, done a few thousand miles in the last couple of weeks with truck shows and various events. In the truck, talking to a lot of drivers, there's a lot of hustle out there. People aren't sitting around. Drivers are busy and doing extremely well. There's a lot of activity going on in the AI infrastructure space, especially around natural gas generators that are moving on drop decks and in some dry vans on the smaller generator side. So the AI infrastructure is still driving a lot of activity out there. The market is busy, but there's definitely more evidence that there are fewer trucks. Just when I look at truck stops that I've been through over the last 20 years, there's a definite sense that there are fewer trucks sitting around as we go through the weekends. All right, in other news, spot rates continue to set new records. May was a month of records. Not only are spot rates for all three equipment types continuing the up and to the right trend observed in 2021, they're even higher this week, setting new records just 4 weeks out from the seasonal July 4 peak. Other news, the ISM PMI came out last week. Manufacturing momentum hit a 4-year high. That's great news, came in at 54.0. That's the headline number. That's the strongest reading since May 2022 as new orders, production and backlogs, very important that backlogs are expanding. That's great news, up for the 5th consecutive month. Trucking services were called out directly as a commodity rising in price as in terms of the comments from the respondents. Supplier delivery times are stretching to their longest since May 2022. Customer inventories remain deep in the too low territory, all signals pointing to sustained restocking demand on some of our industrial trucking lanes. The other news, lastly, I'll just wrap up with this. The LMI came out last week. Zach Rogers, quite an extraordinary report. Transportation prices hit an all-time record. Transportation prices came in at 96. It's the fastest rate of growth ever logged in Zach's 10-year history of this index, while capacity fell to 31.7. It's the widest pricing to capacity gap since the post-pandemic surge. It's a really interesting report, lmi.org. It's worth having a look at. These are some extraordinary numbers. All right, let's dive into this week's market update and have a look at what's happening with dry van rates. Remember, these are line haul rates excluding fuel. We take fuel out so we can see what the actual cost to move freight is. They maintained an upward trajectory last week. Of course, beginning of the shipping month, normally we'd see them head south. They didn't. They're up 7 cents. National 7-day came in at 239. So for those new to the show, remember, this is the national 7-day rolling average. It's not what you're hauling freight for in the northeast or the southeast, for example. This is a national average of all of our lanes. It's about 72 cents a mile higher than last year and about 76 cents a mile higher than the 5-year average. Compared to road check week, rates are up 38 cents a mile, about 19%. And they're even eclipsed the week 22 record in 2021 by about 5 cents a mile. So a record high in dry van last week. Midwest regions up 16 to 283. Top 50 lanes rose by 12 cents to reach $2.87. In the refrigerated market, reefer rates increased by 6 cents a mile last week. 7-day rolling average came in at 269 on Saturday morning. Much stronger than last year, 37% higher, 27% higher than the 5-year average. Compared to road check week, rates are up 14% or 33 cents a mile. They remain about 3 cents under the week 22 record in 2021. So probably they'll jump past that record next week, and we'll have all three equipment types at record levels. In the produce market, USDA reports the average rate per mile, all-in rate for fruit and veg at $4.16 a mile, up 27 cents a mile, week over week, and 85 cents higher than where it was last year, heading into peak. In the Florida produce market last week, there was a big rate swing. Probably the most dramatic single rate swing this season. I don't think the story's over with watermelon season doing extremely well. After the sharp post-Mother's Day correction last week, Central and South Florida came roaring back. Baltimore lanes up 43%, New York up 10%. The origin in Florida remains on a shortage for all commodities. California districts pushed higher across East Coast lanes, with the South District citrus and South Texas stabilising nearly flat after last week's historic collapse. Finding a new floor there, I think, is what's happening in the South District. Yakima Valley in the Pacific Northwest quietly downshifted from a slight shortage the week prior to an adequate supply. That's interesting, worth watching as we get into cherry season up in the PNW. In other lanes in California, there's a divergence between individual lanes in the southeast of California and on some other East Coast runs, but we'll dig into that a little bit more this week when the next report comes out on Wednesday. We're starting to see some pretty serious volumes come into the produce market. So I think this week will be really telling in terms of where rates are going to land. I did make a prediction early in the year that this could be the first year in many years that we've actually seen a produce season. And by that, I mean the upward inflection of rates in the 25 to 30 cents a mile range that we normally see caused by produce season volumes between late April and July 4. It looks like we're on track for that to happen. Even though volumes are rising, they're still lower than they were last year. Lastly, in flatbed rates reached a new high, record high, $2.93 last week, up 4 cents a mile, that is. Remember, these are line haul ex-fuel. This follows 12 consecutive weeks of expansion in the flatbed market. Rates have jumped 25%, or 61 cents a mile, to surpass the June 2021 historical peak by 18 cents a mile. Compared to last year, up 37%, compared to the 5-year average, up about 31%. All right, let's dive into our short-term forecast using Ratecast, going out 35 days. Dry band, first look at what spot rates could look as we move past July 4. Ratecast expect rates up 2 cents a mile out to the 11th of July at 241. Compared to road check week, rates will be 40 cents a mile higher by the time we get to mid-July, continuing that trend tracking 2021 that we've talked about in the last couple of weeks. Compared to last year, rates in the middle of July were $1.66. That means that rates this year could be 45% higher as we head into the summer. In the refrigerated market, Ratecast is expecting rates flat out to 7-Eleven at $2.68. Of course, they were up 32 cents a mile during road check week, and they have held some of those gains since then. Compared to pre-road check rates, rates would be 14% higher by the middle of July if Ratecast is on the money. On July 11 last year, reefer rates were $1.98, so that makes this year's reefer rates potentially 35% higher. In flatbed, Ratecast is expecting rates to surge by about 8 cents a mile to a record high of $3.02 by July 11. Compared to pre-road check levels, this would keep rates about 32 cents a mile or 12% higher by the time we get to mid-July. Compared to last year, reefer rates were $2.08 in the middle of July. That means this year flatbed rates could be about 45% higher. Quite an extraordinary market. All right, lastly, what's happening? Let's wrap up the week. Chris Capelas is talking to Ken Adamo, my former boss and mentor. He's Chief Strategy Officer over at Ease Logistics. A great conversation. It's a must listen to. This Thursday, there's a new episode out. Chris is talking to Mike Roth, Executive Director of the North American Council of Freight Efficiency, or NACFE as we commonly know it, talking about the complex transition from diesel to alternative powertrains. I'm on with Dan Deegan on Wednesday on the I'm All In podcast. I'm also here in Denver talking at the TMSA Elevate conference tomorrow, along with Lee Klaskow from Bloomberg. Make sure you set up alerts for our show, subscribe to our channel, hit that bell so you don't miss another episode. Remember, if you want a long-form version of the report with all of the detailed analysis and charts, hit me up on LinkedIn, include your email address, and I'll add you to the weekly distribution lists. All right, we'll be back next Monday with another freight market update. Be safe, be nice to everyone. Thank you for watching.